here, I think we will go ahead and call the meeting to order. I think everyone has seen a copy of the proposed agenda. Would there happen to be a motion to adopt the proposed agenda?
I move.
We have a move and a motion and a second. All in favor? Aye.
Aye.
Okay, it looks like it's unanimous. Our second order of business is to receive to executive session to receive legal advice pursuant to SC Code Section 3470A2 related to litigation filed by American Timberlands Fund 2 LP and to discuss investment matters pursuant to SC Code Sections 91680 and 916-320. Do we have such a motion?
I'll make the motion.
Okay, we have a second. All in favor?
Aye.
Aye.
Wait a minute, I
Oh.
let me make one brief discussion item.
Yes,
I'd like the record to reflect that I will not participate in the discussion or deliberation regarding the first matter you talked about,
okay, thank you.
American Timberland.
So noted. Any other discussion? Okay, in that case, all in favor?
Aye.
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 Okay, looks like the ayes have it.
Okay.
Here, we'll resume executive session. I think Mr. Hiscock might have a statement to read.
Yes, ma'am. Just for the record, the commission did not take any reportable action while in executive session. Any action that did occur while in executive session pursuant to SC Code annotated 9-1680 and 9-16320 will be publicized. When doing so, would not jeopardize the commission's ability to achieve its investment objectives or implement a portion of the annual investment plan.
Thank you. I think next on the agenda is the Heitman Core Real Estate Debt Income Trust proposal, and I will.
First of all, we want to thank you for agreeing to the special meeting. We do have an opportunity that Alexander Campbell is going to walk us through that is somewhat time sensitive, but I do want to express my gratitude to the commissioners for agreeing to convene on relatively short notice. So thank you, and I'll turn it over to Alexander.
All right, thank you. So this is a recommendation for Heitman Core Real Estate Debt Income Trust, also known as Credit. The recommendation is for a commitment up to $200 million. This is a new open-end vehicle. It's targeting $1 billion of equity. To date, they've got $260 million closed, and with the investment, we'll have fees no worse than 79 basis points. That's a blended asset management fee, and that is the only fee. There is no carry or promote in this vehicle. With the investment, we'll get a seat on the advisory committee, and our own internal ODD has given the fund a pass rating. Heitman is a global manager that's focused exclusively on real estate. They have nearly $40 billion in assets under management, and you can see down below how their three lines of business are broken out. Since 2010, they've done 42 loans at $1.3 billion. And while Heitman is a global manager, this strategy is focused exclusively in the United States. So the relevant offices are the Chicago headquarters, an office in LA, and then they're looking to open an additional office on the East Coast. Currently, there's a staff of 37, but that will grow as the fund continues to ramp up. In the upper left corner, you can see our current real estate allocation with an 11% allocation to debt. That does include the commitment we made in June to Brookfield Real Estate Finance Fund 5. That was a $100 million commitment. And with the first $100 million into credit, that'll take us to 15% allocation to debt. And at the bottom, you can see that we will still maintain a slight overweight core plus relative to non-core. So why do we like debt now? The best way to look at this is if it were a clock. So this is 12 o'clock, this is 6 o'clock, and it kind of works clockwise. We think we're somewhere in between up here 11 o'clock to 1 o'clock. So the market's peaking, asset prices are at cyclical highs, and therefore we feel debt is the best area of the capital structure to be investing in. And when you look at it here, when it's this color blue, that's when it's most advantageous to be investing in that area of the capital structure. So you can see that senior debt still throughout cycles provides a good opportunity to get good risk-adjusted returns. A little bit more about the market opportunity. key point here is right here, these two bullet points, that banks are mostly focusing on the core stabilized assets. These are going to be more longer-term permanent loans, which creates a gap in funding to the higher loan-to-value and transitional assets through shorter bridge loans that are be accessed through a vehicle like credit. The strategy, they're going to target net returns of between 7.5% to 9.5%. They're going to originate floating rate senior loans. So these are going to be loans that are secured by the assets themselves. They will be shorter term bridge loans of 3 to 5 years. And additionally, they will utilize leverage to enhance returns, and we'll touch on that again in a minute. There will be lending to stabilized and light transitional properties, and the focus will be on gateway and new gateway markets, and we'll kind of define that, but that's essentially kind of the primary markets that you hear about, and then new gateway markets are sizable markets that are exhibiting really strong population and job growth. They'll lend to the 4 major property types in addition to a group they call specialty, and specialty includes senior housing, student housing, medical office, and self-storage. And the average loan size will be about $50 million. This is the anticipated portfolio. You can see up here targeting $1 billion of equity, and they'll layer $1.5 billion of leverage on top of that. So with a $50 million average loan size, this will give you a diversification of about 50 loans in the vehicle once it gets fully ramped. And then again, down here at the bottom, you can see the different asset types and their anticipated allocation to those, the specialty, and then you have your 4 major office, apartment, industrial, and retail. Now the target markets, this is a little bit difficult to see, but you can tell the gold dots, these are your primary markets, your gateway markets, San Francisco, Los Angeles, DC, New York. They'll be lending to assets there, but they'll also be placing an emphasis on these new gateway markets, the ones in the blue dots, the Denvers, the Dallases, the Atlantas. These are still sizable, recognizable markets that are really demonstrating strong demographic trends like job growth and population growth. They will, at times, lend to other top 50 metros, and for student housing, they will go into areas like college towns like Gainesville, Florida. This is how the new gateway markets stack up to the gateway markets. This is annual net migration into and out of the different markets. And you can see this dates back roughly 20 years, but you can tell that new gateway markets have really performed well relative to the gateway, particularly over the last 10 years. Employment growth, very similar story. The key takeaway is not only are they producing an absolute number of more jobs greater than what the gateway markets are doing, they're also doing it at a higher rate than what the gateway markets have done. So this is kind of your typical loan that you would see made. Say you have a $100 million building over here. Credit's going to originate this entire 0 to 75% loan to value tranche, and this is going to be the entire senior first mortgage. Now, whereas BREF, the Brookfield Real Estate Finance Fund 5, they would syndicate this piece down here and manufacture a mezz position that they'd retain for the fund. What credit is going to do is they're going to use warehouse financing on the 0 to 45% tranche, and then use fund equity on the 45 to 75% tranche. The other key difference is this will remain entirely a senior loan right here, whereas with BREF, this became a mezz loan. So they will have the senior security against the asset, and that's the key point there. And the type of pricing that you can see in the market currently today is somewhere in the neighborhood of LIBOR plus 350 to LIBOR plus 450. So for this example, we'll just say LIBOR plus 400 is what the loan will be made at. And then the expense for the warehouse line is LIBOR plus 210 in that neighborhood, which leaves a coupon to the fund of neighborhood of LIBOR plus 685. In addition to that, the fund will also get origination fees, extension fees, prepayment fees, all of which accrue to the value of the fund, and that helps them get to that 7.5% to 9.5% net return. So their track record, Again, they've done 42 loans since 2010, $1.3 billion. As it relates to the senior loans, 14 of the 19 loans that they've done have been realized. You can see that the net return there has been 10.6%, which is higher than the targeted returns for credit. And that can really be attributed to the fact that they were doing development loans at times during this period as well, and they will not be doing development loans in credit. Additionally, in the time frame they were making these loans in the 2010, 2011, 2012, they were able to extract better pricing on the loans. And then the one final point down here too is that even though these are bridge loans of 3 to 5 years in duration, they tend to pay off a little bit early. So the weighted average life on these loans that have been realized is just 2.4 years. So this is the gross IRR ranges of the senior loans. Those are in blue, and then the mezz loans in green. This is what you would expect from these type of loans. The key takeaway here is that there have been no foreclosures and no money lost over any of the loans that they've done, the 42 loans. So there's a really low variability of outcomes in senior lending.
Can I understand you say they've had absolutely zero defaults or zero loss
That's correct.
over what period of time?
Since 2010.
It's pretty good.
So, the gross multiples, again, very similar. Seniors in blue, mezz is in green. Type of performance you would expect. Right here, they've had just one senior loan realized at 1.05 x multiple. The rest of them are still unrealized, so they will continue to appreciate as more coupon payments come in. And again, I would point out that because these are shorter term loans of 3 to 5 years, lower multiples are to be expected. They don't have as much time to accrue like they do in an equity fund. So this is right on target with what they're looking for. Previously, they've done 5 loans where they utilized the financing. It's been done on all senior loans, 2 of which have realized, and you can see right here, it did well on those, 1.27 gross multiple. The unrealized over here will continue, they're all performing well and will continue to appreciate as more and more of the coupon payments come in on those as well. Finally, the considerations. Again, this is a new fund, so there is no fund track record, so to speak. However, the team that's in place have done 42 loans since 2010. They've done well, and the 2 portfolio managers have a significant amount of real estate debt experience. The warehouse line is very similar to what we have set up in our private debt separate accounts with Golub and Ares. These are senior loans, just like in those, with some leverage added on top of them to enhance the returns. Additionally, the banks providing the financing, the warehouse financing here, they will co-underwrite each of the loans alongside credit. So there's that added layer of someone else looking at it, and if they deem the loan to be too risky, they're not going to allow the leverage to be put on there. And then finally, regulatory change, very similar to what we discussed in BREF. Anything that's going to happen is probably going to take some time. The benefit that we have here is that we would be in an open-ended vehicle. So if the regulations do change, we would have the opportunity to redeem out. So again, the recommendation is for up to $200 million, and I will take questions.
Would you see the credit type of loan that this is to be more or less risky than the senior and the mezzanine type?
So the biggest nuance that I would say, because they are using the financing here, which essentially creates a structural position very similar to the mezz loan. However, in the case here with this vehicle, it is still within the senior loan. So it is still attached and secured by the asset itself, whereas with the mezz loan, that is going to be secured by the equity. So they can foreclose and take over the equity if you're in BREF, and take over and operate the property. But in this instance, if they foreclose and take over, they take over the asset itself and take ownership of the asset. And one other thing, if they do need to foreclose on one of these properties, they have that equity side of Heitman, This is a very substantial side that we'll be able to take over and operate the asset on behalf of the fund at no additional cost to the vehicle.
Who else do they have in the fund besides us at this point?
They've closed on $260 million, 2 of which are other state pension funds and 3 are fund of funds. And they are looking in this next close with us. There will be, I believe, 2 other fund of funds, and then lined up after that, they have 2 other pensions as well, and more targeting an October, November close. And the group that's the one state pension that is in there already, that's already one of the anchor investors in that first 260, they've been with Heitman for 15 to 20 years on the equity side, and then they had a debt separate account, which is a very similar strategy to this one. But that one is closing out. They've got one more loan to do, and then that one will close out. But they have already recommitted into this fund.
Any other questions for Alexander? Okay, if not, we have a lengthy motion.
Would you like for me to read the
If
motion?
you would enjoy reading that, we will be happy to listen.
The proposed motion would be Heitman Core Real Estate Debt Income Trust LP. A, adopt the recommendation of the CIO and the Internal Investment Committee as set forth in the summary terms chart on page 1 of the due diligence report dated August 11th, 2017. B, authorize an investment of up to $200 million into Heitman Core Real Estate Debt Income Trust LP. C, authorize the CEO or the chair to negotiate and execute any necessary documents to implement the investment as approved by the commission. 1, upon documented approval for legal sufficiency by RSIC Legal. And 2, upon expiration of 3 business day review period, commission on May 1st, 2014. And D, authorize the CEO, chair, and/or the CIO to, or their designees to thereafter authorize a custodian of funds to transfer such funds as are necessary to meet the retirement system trust funds obligations with respect to the investment.
Would anybody care to make such a motion?
I move.
Okay, I think we have a motion and a second. Any further discussion? If not, all in favor?
Aye.
Aye.
Aye. It looks like the ayes have it.
And Madam Chair, that is all the business that we have for the commission. And
Okay.
we would again just echo the thanks of Jeff and allowing us to get you together for a called meeting to be able to act nimbly and to take advantage of some opportunities. So we appreciate that.
Well, and we certainly appreciate you. So is there a motion to adjourn?
So moved.
All right.
So moved. Second.
Everyone wants to adjourn. All in favor? Aye.
Aye.
Okay. Wonderful. Thank you all. Hope you have a wonderful week.